So cash savings from automation. So we can look at net present value to determine if we should make an automation decision. And so the idea here is increased automation from use of robots can yield cash savings. If the present cash savings of a labor cost exceeds costs of an automated manufacturing system, companies should automate the process. So the idea here is we don't just have to look at this from buying equipment. We can look at this from a perspective of, hey, if we should invest in a new system or process. So our net cash savings here is $1,500. Our present value of annuities at 10% is six. As this is a factor we're using, and we can determine if our investment's $8 million here, and we save $1,500, $1.5 million a year. Our net present value is 1.216. And the idea here is we could just change this calculator up. So just so you can all see how this works. 1, 2, 3, 1, 2, 3. Always add an extra 0. So some of the cash flows, net present value, we just change the rate to 10. Let's see, here's 1 through 8. Should be closer to 9. I would trust these annuity cash flows are a little worse than our calculation in Excel. These are a little older dated, so I would always defer to this, and you should get a pretty similar answer. So we're saying the net present value here, our initial investment is $8 million. And so our true net present value, let's see, did I get 8 million here? Oh, difference. Initial investment is 8 million. 1, 2, 3. And so here we're getting a slightly higher. I think here they meant to add cash flows. Yeah, interesting here. I think their calculation is not correct in this slide. So just refer to my calculation here. This is definitely correct. So still, we decide to make this decision, even if our net present value is higher. Net present value. So we can also do this with uneven cash flows. And so let's keep on adding some slides to this. So I'll duplicate this, duplicate. Rename 4.1. Net present value. So let's say we have cash flow A, B, and C. We just have 3 years for each of these. So we'll fix this up a little bit. So you can see A, B, and C. Oops. And our net cash flows here, we're only doing it for 3 years. We can change this 5,000, 5,000, 5,000. Saying, what if we make the 5,000 in year 2? So we can make different purchase decisions here. Some can make us more money at the beginning. Some can make us average annual cash flows, like more like an annuity here. This is a little different. And version C has us not making a lot of money at the beginning, but a big payout at the end. Right? And all of these would equal the total cash flows as being the same. This is our totals. And so the idea here is if we were looking at payback period or anything like that, or our accounting rate of return, we wouldn't be able to capture these timing differences necessarily. But here we can look at, we're determining the rate at 10%, 0.1, and we're gonna make the initial investment. We're not gonna assume it. We're gonna assume a $12,000 initial investment. 12,000. 1, 2, 3. And we'll fix this up a little bit. 11, 11. And so here we go. Boom. So we can see here, right? It's just copy paste over and move some of the formulas around, and you can find out the differences. And so the differences here we can see are that investment, what would we choose out of these investments to buy? And so I would choose both A and both B. A and B give us positive net present value. So if I could choose both, I'd choose both. The decision D, I wouldn't choose. Why wouldn't I choose it? Because it gives us a negative net present value at this discount rate. And so we can see, even though decision C pays us out a bunch at the last year, because of that discount rate, we actually make less. And so we can see that getting the more payment up front substantially changes our decision. And we could easily change these numbers to millions, and this could be a much larger impact. So that's the idea here, is the timing of cash flows really matters. And so let me bring this back to real life a little bit. I have some friends. So in accounting, it's pretty traditional to, and I'm going to talk about some private information here. So I'm going to pause. So how do we compare profitability? So one metric we can use to compare these profitabilities of net present value is we just take the net present value by the amount we initially invested to determine our profitability index. So let's see. So this is kind of the percentage we can see. And if it's, let's see, present value of the net cash flow. Oh, sorry, here, present value of the net present value divided by the amount invested. This is more of a factor that we'd use. It's just another way that we can look into it. But the idea here is, if we look at the total net present value divided by the total investment, if we have an amount over 1, we'd buy. And if we have an amount under 1, we wouldn't invest in it. And so that's what it's just giving different examples here for comparing positive net present value projects. You could use the same thing, but I think we could just do it here. This is the comparison. Profitability. So we're just looking at whole numbers here. If you'd rather not look at the dollars or percentages, we can see here which one's better. We can know the 1.08. We're getting kind of an 8% return on this. And so then this investment we'd choose. So capital rationing, constraints that limit firms from accepting all positive. So just be aware that there's types of capital rationing. So we can have hard rationing, which is we don't have enough money to invest in two projects. Like maybe we only have $12,000 to invest, so we can invest in both of these projects. Or there's soft rationing, where maybe the company has $24,000 to invest, but it's deciding to only allocate $12,000. So just be aware that some can be imposed by external forces, like lack of cash or lack of ability to make these two investments. Maybe both investments are on one piece of land, and some are just internally decided so that other business units can have rationing. So that was great. We covered net present value for straight cash flows, annuity based cash flows, and different cash flows. I'm going to pause here. Is there any questions related to net present value? And I've shared a few other presentations I've done that go into this matter in a lot more detail. I think it's really useful to know. So I'll pause here.